Have you ever felt, like just overwhelmed by all the market headlines? Wondering if you're chasing fads instead of finding real lasting value.
Yeah, it's easy to get caught up.
What if there was some timeless wisdom, something to cut through all that noise and guide your investments no matter how wild the market seems?
That's what we're digging into today.
Welcome to the Deep Dive, where we extract the most important nuggets of knowledge from key sources. I'm host Beaker,
And I'm expert speaker.
and today we're diving deep into the very core of what truly makes a great investment.
We're looking at the foundational wisdom of, well, one of investment history's giants.
Absolutely. Our deep dive today draws on profound insights from Benjamin Graham's really seminal works, Security Analysis and The Intelligent Investor.
Right.
And our mission really is to understand his core traits of a solid investment: safety, earnings, and value.
And Graham's central belief, it's such a powerful starting point, is that a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price.
That immediately shifts your focus, doesn't it? Away from the flashing screen.
Exactly, to the business reality underneath.
Okay, so let's unpack that first pillar, safety. When Graham talks about safety of principle, was he just saying, don't lose money? Or was there more to it?
Oh, definitely more. Graham defines safety as protection from overpaying for a stock
Okay.
and from overconfidence in the quality of their own judgment. So it's about protecting yourself from yourself, too.
Interesting.
And the key concept for him, really revolutionary, was the margin of safety.
Right, I've heard that term. What does it mean in practice?
Well, it's not just about avoiding loss. It's about building this, unshakable resilience into your investments.
A buffer.
A buffer, exactly. It ensures you buy an asset at a significant discount to its true intrinsic worth.
So you're less likely to suffer that permanent capital loss.
Precisely. That permanent impairment. He believed returns should come from intelligent effort, right?
Yeah.
Not just from taking on bigger risks.
Okay, so safety is the bedrock. Got it. Once that's established, what did Graham see as the real engine, the driver of value for a business?
Well, for him, it all came down to earnings.
Earnings. Makes sense.
He identified average future earnings as the, quote, chief determinant of value. He really stressed focusing on the fundamental return.
The fundamental return.
Yeah, or the investment return. Basically what you get from the company's starting dividend yield plus its later earnings growth. He wasn't chasing speculative pops.
That's a really crucial distinction. He even warned against what he called new era investment, didn't he?
He did, that idea, that sort of irrational exuberance.
Right.
Where a stock's desirability was seen as, and this is his phrase, entirely independent of its price. Just pure hype.
That sounds familiar, actually.
It happens again and again. For Graham, that was a radical fallacy. He saw how stock prices could get driven purely by speculation, price-earnings ratios.
PE ratios, yeah.
They'd balloon way beyond the historical norms, maybe around 14 times earnings, up to crazy highs like 27 times.
Wow.
For Graham, a company paying out a liberal portion of the earnings in dividends, well, that adds definitely to the attractiveness of a common stock. It signals real health.
So it sounds like understanding true value means resisting that speculative pull, keeping your eyes firmly on the actual business.
That's the core of it.
So how did he tell us to think about those market prices then? They're always swinging around.
Well, Graham famously used the analogy of the market is a pendulum.
A pendulum.
Yeah, constantly swinging between unsustainable optimism on one side and unjustified pessimism on the other.
So the intelligent investor.
The intelligent investor is a realist. They step back, they, quote, sell to optimists and buy from pessimists.
Take advantage of the swings.
Exactly. He emphasized that market prices, those quotations, they're just there for his convenience, either to be taken advantage of or to be ignored.
So don't let the market dictate your decisions.
Never. He explicitly said, never buy a stock because it has gone up or sell one because it has gone down. Look beyond the price to the real stuff. Assets, earnings power, dividends.
And he wasn't big on overly complex calculations, was he? Those intricate financial models you sometimes see.
Not at all. Highly skeptical. He believed, and I love this quote, the more elaborate and abstruse the mathematics,
Complicated and obscure.
the more uncertain and speculative are the conclusions. He argued that dependable calculations, they didn't need more than simple arithmetic or basic algebra.
Keep it simple. Focus on what matters.
The power of clarity.
Okay, so let's recap our deep dive here. What makes a great investment, according to Graham? 3 core pillars,
That's
right?
it.
First, safety. Build that resilience with a margin of safety. Protect yourself from overpaying.
Check.
Second, earnings. Focus on the fundamental business performance, its ability to reliably generate profits and pay dividends.
The engine of value. Yep.
And third, value. Understand the company's intrinsic worth, separate from market mood swings, and use those market prices as a tool, not your master.
Perfectly summarized. It's about being a business analyst first, not just a market follower.
So as we wrap up, maybe a thought to leave with everyone listening.
Yeah, how will you take these timeless principles, Graham's wisdom, and use them to cut through the noise? How will you approach your own investments with, well, genuine intelligence?
A great question. Remember, time is your friend, impulse is your enemy. Keep learning, stay curious.
Absolutely.
And thanks for diving up with us today.